Hello traders, Gary Wagner here, just after 12 noon in Honolulu, 6 o'clock in New York. It is Thursday, 25th day of March, 2021, and this is the daily report for gold and silver. After trading to a low this morning of approximately 1720, the market took off, actually traded to a high of 1744. We then sent out a trade alert to raise our stops. We raised stops on our futures contract to 28. We'll talk about not only futures, but our spot as well as our GDL trade when we pull up our technical studies, and that begins now. Traders, within a fairly defined range with a low of 1720 and a high of 1744, we did see gold close under pressure, down $7.80, currently fixed at 1725.40. If you recall, we entered a trade at 1722 and change. Once the market opened, hit a low, and then started running higher, we did raise our stops. We raised them to 1728 in case the market did fall back, which in fact it did. We'll talk about the profits that we got on that, and we'll talk about our current GLD trade when we pull up our charts. Traders, we also raised our stops on spot or Forex gold. We entered that trade at 1724.40, raised our stops twice, and then this morning we raised it to 1729. We got in at 24 and change, out at 29. Currently, we have Forex gold at 1726.90, down approximately $7 and change. And traders, lastly, we are looking at GLD, the Spider Gold Trust, currently down about 60 cents per share at 161.78. On this particular trade, we entered at 161.55. We raised our stops today to 161.90, which is where we got out with a little bit of profits. Again, we'll go through those when we pull up our charts on gold. On today's show, I want to give an explanation as to why I moved the stop up so quickly and so tightly. We did raise it to 128 in terms of gold futures, the April contract. It did get hit there. We got in at 22.80 and out at 28. So we had a profit of just over $500 per COMEX contract. The key was this. We certainly positioned ourselves properly, I believe, after hitting these lows back at the beginning of the month. We did see a fairly sizable rally, but that rally really peaked out at around 1750, and then we saw the market begin to trade sideways. Another way to look at it is to simply enlarge and look at the candle color. And what you'll see when you do that is that we pretty much have alternating colors between red and green, meaning up days and down days. We have fairly strong support, as you can see right here at 1720, and that's based on these series of lows here. But we also had consolidation and some resistance, short-term resistance, at about 1750, and that's these series of highs here. When I saw the market run up this morning and hit those highs at approximately 1744, I felt that if it holds and moves higher from here, we're positioned well, but I wanted to lock in profits in case it backfilled, and it certainly did that today, currently at 1725.40. So we got out above current pricing, and in terms of our next move and what I'm looking at is I really want to see gold pricing either break above this congestion band that exists between, call it 1740 and 1750, 44 was the high today, before I can really return to even a modicum of a bullish demeanor. My concern on the downside is a break below 1720, because if it does that, it will probably track to this low here. That comes in right below $1,700. I believe 1,700 is a key psychological level, and that level must hold. Now, the other concerning factor, and I mentioned this when we went through pricing, was when we look at the differential price range between, for example, the 200-day moving average here and the 100-day moving average here, without any question, they are widening. And widening means that it is getting more bearish. We'll look at a Henkinashi in just a second. The same can be said when we look at the 100 and compare that to the 200-day. That has really been widening. And then lastly, as we spoke about, we are in full bearish alignment with the 200 being followed by the 100 and then by the 50-day moving average. And traders, my other concern that I had with our current trade and why I just wanted to pull profits rather than risk having this turn into a losing trade was the Henkinashi charts, and we've been talking about this for a week. As the market came down, we could definitely see that it lacked any upper wicks. It was in solid bearish formation. That occurred up until about the 8th. We had a beautiful pivotal candle when we look at the price action on the 9th. That is this candle here. We then went to higher pricing. The lack of the lower wicks right here were good. But then we had this doji followed by smaller body candles and then smaller body candles with both upper and lower wicks. We got that for 4 days in a row. And what I said as I saw that throughout the end of last week and the beginning of this week is what that is indicating to us, that the bullish trend that was there at the beginning has absolutely began to wane. And so when we started getting these red candles, my sense was that we could see that pivotal candle on the Henkinashi and realize that will always lag behind real time because it is a moving average based chart, because they're fixing the open on the midpoint of the prior day. And so we've gotten this pivotal red candle here, which means that we could see the market track lower in the upcoming days. Right now, we are flat with no current positions in either gold futures. We pulled profits, gold forex, we pulled profits, as well as our GLD, in which we took profits. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.